From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to another episode of the Simple Numbers Profitability Playbook podcast. I'm Mike Maxon, and there is no Brandon Gray today. Now, from what I hear, last episode when I wasn't on, he talked some mess. I'm not going to do that. I don't like to talk bad about my son, but it's good. We'll have a lot of fun here without him. We'll be talking taxes today, so we got a special guest for us. One of our tax partners out of our Panama City Beach office, Reagan Glaze, to talk all things tax. Reagan, thank you for joining us.
Hey, Mike, thanks for having me. This is my first podcast. A little nervous, excited to be here. I'm Reagan Glaze. I'm a tax partner in Panama City Beach, Florida. I work with Mike and the Simple Numbers team all the time. We have tons of clients in common. I joined CRI back in 2021, came from a large local firm in Birmingham, Alabama, merged in. They made me a partner last year. I'm having a great time. It's a lot of hard work, but I love what I do. And I love working with Mike and the team.
Yeah, thank you. Yeah. And for everyone listening, before we get started, remember this is a podcast. Don't be taking what we say and trying to do your stuff. Always consult with a tax professional or a CPA or someone on your own stuff. Okay. This is merely topics discussing taxes. It's one that we all love to talk about. And we're coming up on that time of year. We got the 315 and the 415 deadlines coming in here. And just be mindful that this is banter around taxes and to always check your own situation before we do that. So wanted to get the legalese out of the way before we dive into taxes.
Absolutely.
Yeah.
I'll move. If you're not sure, don't take anything I say here today to heart. There's a lot of opportunity out there within what's allowed. If you're not sure, if you don't have a tax advisor, call me. I'm happy to help. But there's a lot going on in tax world today. That time is upon us. It is February 9th. We've got hundreds of tax returns already in the door for this filing season. So in addition to that, we've got tons of new legislation and lots of changes going into 2026. So while we're doing all these filings for 2025, we're also preparing and adapting to some changes for this tax year.
That's I know there's the big beautiful bill stuff. There's that. I mean, what are you hearing from people just in general? Like what are some concerns people are saying when it comes to taxes right now? Is it just, hey, what's in it, or does this apply? I mean, what is just like the overall sentiment of help that business owners are looking for right now regarding taxes?
Sure. So up until we got one big beautiful bill, OB3 is what I call it. We got that in July of 25. Before we got OB3, we were still under Tax Cuts and Jobs Act of 2017. And most of those provisions were set to sunset at the end of 2025, or at least be phasing out by 2025. So those are the tax concepts that we've known to be true for the past close to decade. We were kind of facing a little bit of a cliff. Everything that we know to be true is not codified. It was going to go back to the old. So if you remember the old pre-CTJA, higher rates, bigger, you got a personal exemption. It was a smaller standard deduction. More people were itemizing. The SALT cap wasn't there. You could deduct your state and local taxes in a meaningful way. So that's the old. And that was what was set to come back without extenders. So what OB3 did was give us some certainty. It made a lot of those provisions permanent or expanded them in some way. So whether you like it or you love it, at least we know where to go from here, and we're no longer unsure of what kind of legislation we're getting or if we're getting anything. So a lot of those provisions, the lower tax rates, the bigger brackets, QBI deduction, all those things made permanent. So for purposes of planning, it's nice to just know what you're up against and not be thinking, well, do I have to plan for the old and the new and just wait and see what we get? So again, whether you like or dislike OB3 or even TCJA is going to come down a lot to what industry you're in, but at the very least, we've got some certainty.
Sweet. So I'm gonna take the reign here for a second from just from my view as being a business consultant working with and remember I know enough about tax to be dangerous, right? That's why you have to talk to them because we don't need me talking to them. Um, but I get a common question I get when people reach out, like Mike, I really need my last person didn't give me tax strategy. And they seem very forceful. We're looking at each other in the eyes, and where he's like, they're like tax strategy, and I'm going, they don't want to pay taxes, right? Or what is it when a business owner wants tax strategy? What explain to someone that if they are getting good tax strategy, what does that look like for a business owner regarding that? Because sometimes I only think it means one thing by the look in their eyes, and really it probably means something a lot different from the actual right way to do things, right?
Yes, and I like that people want to be involved in their own taxation and be educated. And there are some people that say, I want tax strategy, I want tax planning. And then those same people will say, well, I just want you to do it and take care of everything and leave me out of it. And those two things don't really go hand in hand. Um, if you're doing active tax planning and tax strategy, it is kind of boring. I mean, it's checking in. I would say semi-annually. It is not getting some crazy write-off for you took your family to Italy and called it board of director meeting. It's not that. It's conceptual, it's long term, it's looking at 5 years, it's making good choices about corporate form, picking appropriate salary, making correct depreciation elections. It is more holistic and it's a little bit boring. And it is not the things you see on TikTok. But it is a relationship and you need to be checking in before the end of the year. If you come see me in April and say, I want you to do my taxes, but we've not talked all year, there's not a lot I can do at that point to help you. It's too late. You need to be during the year asking questions, meeting with your advisor, and making a plan and making good choices all year long, not just at the end or in filing season.
And I think it's important too to note, and I know one thing that we do with our clients is, making sure they're understanding what amount they owe every quarter and looking at that and revisiting it. I think people handle the deadlines a lot better when they know sort of the pain that's coming or potentially coming along the way. So, I mean, I imagine you suggest that or recommend that they meet with you every quarter, right? To do
I don't necessarily think we have to meet every quarter. I do want all my clients to be educated on estimated tax payments and the rules for making those payments to avoid penalty. The penalty used to be, I don't want to say small, but I mean, it was smaller than it is now. So now that number has grown. There are two options for avoiding penalties when you're making your quarterly estimated tax payments. One is you pay in 4 equal installments, 90% of your current year tax. So that's a little bit of a guess, right? That is every quarter you sit down and say, well, this is my profit through today, and this is what I'm projecting for the end of the year. So 90% of tax on that divided by 4 is what I'm going to pay. So sometimes that's the right way to do it. Understanding for penalty purposes, it's a little riskier because it's a guess.
Mhm.
The other option for avoiding penalty is paying in 110% of your prior year's tax. If your business is growing and you're making more money every year, I generally always suggest you at least do the 110% rule. And if you sell a piece of property for $10 million in 25, certainly you don't want to pay 110% of that tax.
Right.
Perfect. So it just depends on your need. For most people, most small businesses, those people that come in once a year for taxes and maybe just call me during the year if something comes up, I hand them with their tax return vouchers for 110%. Or if they know they're selling something, I'll go ahead and do the math and send them on their way with vouchers. If it's very important to you to be down to the dollar every quarter, yeah, that probably needs a meeting.
Another thing we get lots of questions on or people call and a lot of times this is more from newer businesses that call, but they want to know about what is the best entity structure. And I get that it can be vague, right? But there's some that come in and they're just LLCs, they're partnerships or S corps or C corps, or they're nothing at all yet, or they're just a sole proprietor, whatever it is. what is your what is the thought process that you could share around maybe selecting which one is right for you
Yeah.
to start?
This is a huge choice. If you're a brand new business, I almost always suggest single member LLC is where you start. You can elect anything from there. You can add a partner, you can elect us, you can choose to be taxed as a C corporation. So your corporate form for tax purposes, a lot of times is going to come down to your industry. A lot of people I'm seeing want to do C corp, which is typically not popular, but they're aware of qualified small business stock exclusion, and their goal is to sell in 5 years and take advantage of that. And that's a great concept, but you've got to know in your industry, are you likely to get a stock sale? If your business is renting heavy equipment and you have got tens of millions of dollars in original equipment costs, you're not likely to get a stock sale. So understanding your goals, your expected income levels, how you're going to capitalize, all of those things matter. What I see a lot is people who have made an S election too early. And I love an S Corp. I think it is a great way to save on payroll tax. It's a good tax structure for, I would say, most small businesses I see are S Corps. But there is an administrative cost to an S Corp. You have to now pay me to do 2 tax returns instead of 1. You must do payroll as the owner. So that means you either pay me to do the payroll tax returns or you hire someone to do them, or you get a payroll company or whatever. So you're looking at several $1,000s in admin costs immediately. And sometimes it doesn't make sense to go there until you've reached certain levels of profit. So I always suggest start at single member LLC, go talk to a CPA. I see a lot of people come to me and they've elected S too early. So that the administrative costs, the payroll taxes are more than they're saving in income tax.
Nice, good. And another thing that we talk about a lot, and I mean, again, there's a couple of these I know and get, and I need you to explain it because sometimes when Mike says it, it's like let's get the tax pro to do it, but cash and accrual, right? Another one. How do I keep my books? How do I file my returns? You know, obviously we want cash basis for returns. That's pretty understood, but tell us sort of that thought process around the cash for accrual side of things, the benefits, the pros, the cons, essentially of what might make someone do one or the other.
Sure. So typically, I like for our people to be cash basis for tax until they must convert to accrual, and you must convert when you get up above certain levels of revenue. Something like $31 million over a 3-year average is when you must convert to accrual. And what that means for a small business is um, if you're cash basis, you're only paying tax on the sales you get paid for, and you're only deducting your expenses that you actually pay out in cash. So cash in, cash out, you are taxed on the net of that. Accrual means you're taxed on your AR, whether you collect it or not, but you also deduct your AP, whether you pay it or not. So a lot of people in their business need to know those AR and AP numbers for good financial decision making. So when they hand me the tax return, it has AR and AP on it. And what we'll do at tax time is go ahead and convert that to cash for tax. So a lot of times that ends up in I hand people their tax return and they don't really know, they don't recognize the numbers on it because they've been looking at their accrual financials all year. So when you're meeting with your CPA, it's important that you're understanding how you get from accrual basis net income to what you're ultimately taxed on, that cash basis net income. So I have that meeting a lot with clients.
Nice, nice. Yeah, that's a very popular topic. And one of the things I want to flip to, which is always a fun one, and I am sure it's fun on your side of it, is sort of the I got this thing. It's gonna save me all kinds of money. Come on, I know a guy that did it, right? I was
Mhm.
at the bar and he told me that um he saved all this money on taxes, right? And so I'm gonna go through some things and feel free to add in what I missed. But I'm gonna go through some things. Um, Buying equipment at year end saves me taxes.
It's technically true, but I'm more about saving dollars than saving taxes. And some people were in the camp of they'll pay anyone as long as they don't pay the IRS. And I, I understand that perspective. I don't necessarily agree with it. Um, I think that equipment dealers, car dealers are aware of this mad rush to buy stuff before the end of the year. So I think a lot of times you're not getting the best deal. And if you're just running out and buying things that you don't need to save 30 cents, I don't know that that's a good business decision. I certainly.
What about the 179 deduction?
Yeah, I mean, same thing. Bonus depreciation, 179. It's just writing off the full cost of that asset when you buy it. And certainly it can save you taxes. Whether you should is something that you need to talk to your CPA about. Sometimes I have a profitable business and we'll still elect out. Just depends on what happened in your year, what you've got going on outside of the business, what you expect to have going on in the coming years, and when you need the deduction most. I don't think that's a bad strategy. It's not one that I suggest very often. I just suggest that you be educated and understand the impact of what you're doing and just relieve yourself of this pressure that you need to go out and spend all your money.
Right. Yeah. And what I think of the 179 deduction is they sometimes do it because, oh, look, I paid nothing, but you can't take that in future years. So it's gone at that moment. And so if next year you're going to grow, you got everything in place. Well, what if next year your profit doubles or triples or what have you, and you've lost that depreciation? Now so it looks more of, sometimes it can be a deferral on what you're going to pay later. I mean, that's one way I think of it.
Same. And when it's a small business, I really like to line up the deduction with their cash flow. So if you have financed a piece of equipment and you're going to be making payments on it for the next 5 years, you've got to understand that that's cash out the door with no tax deduction associated with it. So when you write off the equipment in year 1, but your cash is not going out until years 2, 3, 4, 5, then you've got a cash and tax timing difference. And for a small business, that can create some tax pressure.
All right, here's another one. My retirement contributions are tax-free.
Tax deferred.
There you go. There you go.
Yeah, it's a good tool. I mean, if you are in your earning years, the expectation is that you will retire and your income will be less. And when you pull it out, it'll have all these earnings and your rates will be lower. So it is not tax-free. It is deferred. The earnings in a Roth IRA are ultimately tax-free. So that's your opportunity to get some tax-free earnings, but your contribution is just a deferral if it's a traditional or regular 401k.
What about depreciation on real estate means I'll never pay tax?
Wrong. Well, it depends on your industry. If you're a real estate professional and you have a bunch of properties and you're slowly depreciating them, I suppose here's the thing. For at least one person out there, anything can be true. For the majority, no. There's a lot of companies out there selling cost segregation studies, and they do not care if it helps you or not. They just want to create a study for $3,000 and send you on your way. I have had so many people bring me a study that they had prepared for a long-term rental, and they have a day job and they just have one rental, and they thought they were going to get this big write-off, but they don't understand things like passive loss limitations. So just because you get the depreciation deduction doesn't mean that you can use it to offset your W-2 income or income from other sources or anything like that. You can carry it forward until you can use it, but generally those passive losses are limited to zero unless you are a real estate professional.
Yeah. That's good. Another one, we talked about cash and accrual basis. That was another one, sort of doing that one. Just meaning they won't pay taxes or they'll pay less tax. I mean, again, you obviously end up paying it. But what about losses this year? It means I save taxes forever, right? Just carry forward those losses and I'll be good.
This goes back to that. I prefer to save dollars versus save taxes. The basis for a loss is $1 out the door. And certainly if you lose money, you don't pay taxes. I never think it's a good thing to lose money. So if you have a loss, you won't pay tax. You can carry forward certain losses, but again, those losses may or may not offset future types of income.
Correct. What another one? Deferring income. Any sort of issue with deferring income?
Meaning? Don't
Um,
deposit or don't bill or things at the end.
correct. Yes, correct. Yes.
Okay. Um, it's a thing. It's a strategy. If you choose to not invoice your customer until January versus December, yeah, that could save you. If you're accrual basis for tax, that could save you some tax. Understanding that your client or your customer is going to have competing interests. They want to go ahead and pay the bill and get the deduction in the same tax year. So
Yeah.
I think a little bit of it is this is life. The bills are due when they're due. You got to get paid when you got to get paid. But to the extent you can manage it, you should.
Yeah. Yeah. What am I missing? I wrote some down that I hear. What am I missing?
I hear a lot of people call me about things they've seen on TikTok. Luxury vehicles, 179 on luxury vehicles if you have a rental. Um, I don't like to be mean CPA and say no. I say yes to a lot, but we've got to be reasonable. Some of these, and then I mentioned the board of directors vacation for the family to Italy. That was a real question I got, and what it came down to is there are IRS rules for travel and whether or not it's deductible. And if you're gonna log your time and what you talked about, maybe we could do a pro rata deduction. But ultimately, it's a high risk, low reward. The juice is not worth the squeeze. And I would encourage you to go on vacation after tax and enjoy your time with your family and your friends and kind of just take some pressure off. Not everything has to be a deduction. When you get into business ownership, it does feel like you need to have your thumb on every dollar and figure out how you can get a deduction for it. But again, I think the best long-term tax planning results are the choices you make over a 5-year period and not necessarily just working to get a deduction for something that's on the line.
Correct. What about one thing I see a lot, especially in the small business world, is running them personal expenses through. Lots of personal expenses running through the business. And I get it, people do that and it's part of it, but what is some of the risk or exposure there or how that should be handled? I mean, we all know that, hey, the chances on things getting audited are low, and that's sort of the gamble people take is that, hey, I'm a $2 million business, I run a bunch of stuff through, but share with your thoughts on all that.
Yeah, I'm not an auditor. If a client hands me their financial statements, for the most part, I'm trusting that they have included their business expenses. And things like your personal cell phone, I think there's a good argument for that. Everybody needs a phone. If you own a
Yeah.
business, you have to call. So things like that, I'm fine. If you're doing vacations and the hair salon, and then we have to have a discussion and say, this is not deductible. It really needs to be a distribution. At the end of the day, it's your tax return, but I have to sign my name on it. So we have to agree on a certain level of towing the line. I'm not ultra conservative, but at the end of the day, I'm not going to be the one paying the tax and paying the penalty if you're under exam. I have a duty to tell you that these things are not IRS business expenses.
Nice. So before we go, is there anything you want to leave the audience today when it just comes to overall taxes? One of the things, I mean, again, there's lots of stuff here. We get there's ins and outs, do's and don'ts, gray areas, all that stuff. But when it comes to just taxes in general for business owners, what's one thing you'd like everyone's sort of thought process to be when approaching it?
Don't be scared and don't do it yourself. A lot of people are so anxious avoidant about their taxes. And my advice to you would be find a CPA that you, on a personal level, like and can talk to. It's a very personal choice. And let them educate you so that you have at least a rudimentary understanding of your taxation and what you're paying and when and why. You don't have to be in the dark about this. There are ways to manage it. And it's something that is very easy to mess up by doing it on your own. So you really do need an advisor. And the best time to do it is before you start doing the things you're thinking of doing. So before you make an S corp election, before you run out and buy a piece of equipment, before you set up a retirement plan, you need to have someone that you can talk to that understands the tax implications of these things.
Awesome. Well, sweet. Well, thank you for joining us and providing us some good insight. I think everyone's going to get a lot out of this because I don't think there's rarely a meeting that goes by where something regarding taxes is not brought up. And while we can't cover everything, We can bring you back in different times to get you on here to explain some more stuff. So, well, we appreciate you. So, everybody, thanks you for listening. I'm Mike Maxon. That's Reagan Glaze, and we will catch you later.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.